Hello everybody. Today it will be my ninth lecture series, where I've already mentioned in my Facebook as well as the YouTube and my in my LinkedIn profile that I'll be delivering a session on IPO. That is called the initial public offer. We all know about the IPO, and we always see the advertisement which has been given by the company in various newspapers across the country, that what is the IPO, that to invest the or to invite the investors. It can be the retail investors or institutional investors to invest the money in their money in the companies, and it is in the form of a IPO. IPO, the initial public offer, is actually a very important constituent of the capital market. Now, we all know that the Indian capital market is being regulated by the SEBI, Security Exchange Board of India. And Indian capital market is divided into two important components. One is a primary market, another one is a secondary market. Primary market is an area where actually the issue of public shares are being handled, as well as the secondary market, where the shares which has already been issued in the market, means where the shares are listed in the stock exchanges, they are traded in the secondary market, that is in the stock exchanges, where you can go and buy and sell the shares on the stock exchange platform. We have all know that the BSE and the NSE, that is the Bombay Stock Exchange and the National Stock Exchange, are the two main stock exchanges in India, who actually deals with the dealing of equity shares and various other financial instruments like bonds and debentures the derivatives, the futures and options. So today, our main focus as for the discussion will be the initial public offer or the IPO. Now, what is an IPO? And why IPO comes into the picture when the SEBI has got a regulation in this case. Now, it is very important to understand that capital market is an important constituent of a free economy. And the IPO, its origin comes from the USA, where it is being regulated by Security Exchange Commission or the SEC, where the counterpart in India is the SEBI, Security Exchange Board of India. Now, actually, public issue of shares means the selling or marketing of shares for subscription by the public by the issue of a prospectus. Actually, company issue a prospectus before going for IPO. The prospectus is a mandatory document which is to be filed with the SEBI as well as with the company, the Ministry of the Corporate Affairs, and for going into for public issue of shares. Now, for raising any capital by the companies from the public, the issue of shares that a public company has to comply with the provisions of Companies Act and the SEBI Act 1992, means Companies Act 2013 and the SEBI Act 1992, including there are some many rules and regulations under the Companies Act as well as many regulations under the SEBI Act also. So, and it is being regulated by the Security Exchange Board of India. These guidelines and instructions, which is being issued by the concerned government authorities, and also to include the stock exchanges and other regulatory bodies. Public issue is where a company actually issues securities to new investors for becoming a part of the shareholders family of the issuer, and this is called the public issue. Issuer is the name or the a term which has been given to the company who actually issues the shares to the investors to invest. Mainly, there are two category of investors. One is the retail investors like us, the individuals who actually invest in the equity share of the company, and there is also a kind of an investor is called institutional investors, where banks and financial institutions are involved. So there is also another category of IPO is called FPO, further public offer. FPO is that any kind of company who has already got their shares listed on the stock exchanges, they can come up with another set of further public offer for the subscription by the investors, and it will be subsequently being listed in the stock exchanges. There are various concepts like rights issue, bonus issue, private placement, and the opportunities which is given to the employees in the case of sweat equity share or the employee stock options. Now, the important concept of the term to know for us, the investors, is the red herring prospectus or the offer document. Offer document is something which is given by the company, which is where all the information relating to the company is given. For example, if Reliance is coming up with a new share in the market after launching a new company, so in that case they will give us a offer document, and that offer document is considered to be a principal document where all the details of the company is given, the assets and liability information is given, the auditor's certificate is given, the underwriter's information is given, the share transfer agent's information is given, and all those financial informations of the company are given. So, and it is also mandatory under Section 31 of the Companies Act 2013 in case of a public issue. Now, what is a red herring prospectus? Red herring prospectus means a prospectus which does not include complete particulars of the quantum of the price of the security offered. Now, provisions of the red herring the prospectus are applicable to all the companies except those which are covered under the shelf prospectus. A company proposing to issue a red herring prospectus shall file with the ROC at least 3 days prior to the opening of the subscription list and the offer. So there are many concepts like a red herring prospectus also. Now you will see that in advertisement, the company always mention a term called book building process. So what is a book building process? Book building process is something where in a fixed price process, the issue price known in advance to the investors, while in book building process, the issue price is not known in advance to the investors as only the price band offer. For example, if you have got a higher price band of 700 rupees and the lower price band is 600 rupees. So this is where the book building measures comes, where the fixed price is not. It is variable in nature. Where the fixed price is mentioned, it is known to the investors in advance. Now, book building process undertaken to elicit the demand and to assess the price for the determination of the quantum or the value of the specified securities in India. So, if you don't able to value a particular share, one share, the value, a share of the value of a one share, then in that scenario, these book building measures where it gives a range of the price band that how much will be the quantum of the value to be determined. So book building is a process which is used in the IPO for efficient price discovery. It is a kind of a mechanism which during the period for which the IPO is open or the initial public offer is open, bids are collected from various investors at various prices and which are above or equal to the floor price. It can be the floor price or it can be the upper price. So it depends on the kind of bidding that the investors has given. Accordingly, the valuation or the price will be settled. And who are the qualified institutional buyers? Qualified institutional buyers are actually a kind of institutions or large banks of financial institutions who get involved in this process of IPO, which is being floated by a company. So it is on a large scale. Qualified institutional buyers are those institutional investors who generally perceive to possess expertise in the financial proficiency to evaluate and invest in the capital market. And there are many categories which has been given under the CV, like category 1 and category 2 for the foreign portfolio investors, public financial institutions, scheduled commercial banks, provident fund organization, pension fund organization, national investment fund, insurance fund, systematically important NBFCs, and multilateral and bilateral development financial institutions. Now there is also a draft of a document which is quoted for the company if there is any kind of changes going to take place in the final offer document. So these are placed before the investors, whether it can be QIB, that is I have already mentioned just now, that is the qualified institutional buyers or the retail investors. There is also a concept of anchor investors. Anchor investors are basically means a qualified institutional buyer who makes an application for the value of at least 10 crore of a public issue. Means these kind of things are being done at a large scale, and the main board made through the book building process is in accordance with this regulation. There is also another concept of understanding the various regulations of the asset criteria and the profit criteria, the net worth criteria, as well as the name criteria. The issuer must have a net worth of rupees 1 crore each of the preceding three full years, calculated on restated and a consolidated basis. Means the asset as well as the net worth position should comply with the regulations which has been given by the SEBI. Otherwise, he will not. Otherwise, that company will not be eligible for the issue of initial public over the IPO. Another very important area is the what is the lock-in period for the promoters. There is also a provision of lock-in period. For example, sometimes it is 3 years from the date of the allotment. So lock-in period for the excess of the promoter's contribution, it can also for a period of 6 months. So there are many provisions of the SEBI as well as the Companies Act in order to understand the various areas of the initial public offer. Just before ending the initial public offer session, I would like to mention that the biggest the IPO which has been issued till date is a Saudi Aramco. Actually this is a petroleum company, and the IPO which has been issued by the Saudi Aramco is something like in 2019 it was 29.4 billion US dollars. So you can understand the size of the IPO and the size of the company, that what it goes, and the 29.4 billion dollar. There are many companies which have got the largest number of IPOs which has been floated across for the investors. For example, like Alibaba Group, SoftBank Group, Agriculture Bank of China. We have got Facebook. We have got American International Assurance. So these are the various large-scale IPOs which has been floated by many companies across the globe. The stock exchanges, obviously prior to 2009, the United States was a leading issuer of IPO. The main hub of capital market was IPO market was the United States, and in terms of the total value. After that, the Hong Kong Stock Exchange, the New York Stock Exchange, the Nasdaq, the Shanghai Stock Exchange, the National Stock Exchange of India is also there. In 2024, NSE has entered into this IPO space with a 20.3 billion proceeds have been generated through the NSE. That is the National Stock Exchange of India. So my main objective today was to understand the concept of IPO, because the government of India as well as many investors are looking for the opportunities to enter into the equity market. So before understanding the equity market, we need to also understand that it is a stepping stone for the equity market, that IPO, initial public offer. Then it comes into the area of secondary market. In our next lecture series, we will talk about the secondary market, the functions of stock exchanges, the importance of the SEBI regulations, the importance of Companies Act, and the many areas like how the individual investors will invest in the equity market, like the mutual funds or the portfolio funds or the derivatives or the options or futures. There are many areas where we will study and we will have a discussion on that, and it will be very helpful for all of us, including the retail investors. Thank you very much for joining.